So what do you think? Are you feeling pretty good financially, or do you feel like you might be falling behind? I've been a financial advisor for over 20 years, and I've helped guide hundreds of families towards saving for their retirement and hitting their financial goals. And today I'm going to share with you the key financial milestones I really want you to hit, if at all possible, before you turn 40. Let's jump right in. And the very first one, and it sounds boring and I probably shouldn't lead a YouTube video with it, but I want to make sure that you have an emergency fund. Hopefully you had an emergency fund in your 20s and in your 30s, but if you didn't, boy, before you start 40, you really want to have this fund in place. So what do I mean by an emergency fund? It's 3 to 6 months of living expenses, probably just parked in the bank. It's fully liquid, you're able to reach it if something happens. So why do I want you to have an emergency fund? You know, the short answer is, I think it gives you the ability to live your best life should something bad happen. Let's say you get laid off from your job. I don't want you to take the first job that comes along. I want you to take the best job for you. And that might take a couple months. You might have to turn down a job or two while you're looking for the job that's right for you. And you know what? You need to have money in order to be able to navigate that, particularly if you have a family, if you have young kids at home, if you have people that are depending on you, you have a mortgage, you have a car payment. I don't want you to feel the pressure to take the first job. I want you to take your best job. So that's the first one, is an emergency fund. It also obviously helps. You have an unexpected emergency room visit. You break your arm and it costs $1,000, or you have an unexpected car repair. Over half of Americans could not pay for $1,000 unexpected expense. I don't want that to be you. I want you to be able to pay for that. And more importantly, I want you to continue to have alternatives and choices should something bad happen in your life. Okay, the next one. By the time you turn 40, let's pay off those high interest credit cards, any high interest loans that you might have. Maybe a car loan, if you have a car loan that's 7-8% or higher. I've seen car loans 14-15%. If that's you, I really want you to focus on, before you turn 40, let's get that paid off. Same thing with the credit cards. If you have credit card debt, really ask yourself, how much joy did the things that you bought on that credit card actually bring you? And for a lot of people, when they look at that, they say, it really didn't bring me much joy at all. It was just an impulse buy. I was at the shopping mall, I saw something. I was online, I saw something. Unfortunately, and mea culpa as well, the Amazon cardboard boxes show up at my house way too often. And how many times are they truly bringing happiness, that logo that Amazon has? I think happiness is brought to you by doing things with people you enjoy spending time with, having adventures and having experiences. So look at your credit cards. If you're running a balance there, do what you can to stop putting more money on your credit cards and really focus on the things that bring you joy. And let's bring that down. There's the snowball effect, where you pay off your small credit cards first so that you can have some feeling of some success. Credit to Dave Ramsey for that. Let's say you have 4 credit cards, and one card you owe $500, the next one $1,000, then $2,000 and $4,000. The snowball would say pay off that $500 first, because it makes you feel really good. I can't help myself as a financial advisor. The academic answer is pay off the one with the highest interest rate. Okay. This chart here talks about what the average credit card debt is by age. And so if you're an average person about to hit 40 years old, unfortunately, the average American has $5,500 of credit card debt. Let's keep going on this. 42 to 57, it's almost $8,000 on their credit card that you're paying 19 to 30% interest on. Please, please get that paid off. Even people that are super close to retiring, 58 to 76, it's over $7,000. And people over 77 years old, this is kind of shocking. And the source on this is Credit Karma. But 77 to 94, it's $5,800. That's a lot of money for somebody at that range. You know what I want to see that balance be for you? As far as the balance that's not paid off, I want to see it 0. I don't have a problem if you want to put things on your credit card. It's the way America lives, right? It's our system. We put things on our credit card, get those benefits, get those free airline miles, but pay off that credit card every month. Okay, the third item I want you to do, the financial milestone before you hit 40. The third one is, if you still have student loans, I want you to really work on paying those off, okay? So another chart here, let's see what the average student loan balance is by age group. And it shows why the student loan balance is really a danger to American society and for Americans to be able to hit their own financial goals. So people under 30 years old, almost $24,000 of remaining student debt. 30 to 39, almost $43,000 in student debt. This is a lot of money that's being owed. 40 to 49, $45,000. 50 to 59 is $44,000, and then 60 plus is $35,000. Those are big student loans to have remaining, to have over your head for as long as that is. So that's a lot of time. Okay, milestone number 4. You know, as you enter your 40s, you're starting to feel the pressure of the world on your shoulders. You may and probably do have a mortgage payment. If you have a family, you know, your kids are getting older and, you know, they're starting to want things as well, and you want to provide those things. It can be an expensive time in your life, and it can be a time with a lot of pressure on you. People are depending on you, and so I want you to evaluate how much life insurance, whether you need life insurance, and if you do, how much life insurance that you need. Now, what I'll say is, yes, I'm a financial advisor, but I'm what's called the fee-only financial advisor. So I don't want to be licensed to sell insurance, and I'm not licensed to sell insurance. So reach out to somebody that is licensed, but really ask yourself, if you were to pass away, what are the responsibilities? What would the life be like for your kids? And if you're married, your spouse, if you're working without your income. And if you're taking care of the kids, if you're not working outside of the home, I want you to think about what it would cost to replace the services that you're providing for the family. That can be a lot of money. It's not unusual for me to see a couple where one person's working and maybe we have $500,000 of life insurance or $1 million of life insurance on that person, but only $100,000 of life insurance on the person that's staying at home and running the home and making your house a home for your family. And it's expensive to replace those services. And I would say that the person staying at home, $100,000 is probably the bare minimum you want to have on that person. And I'm not licensed to sell insurance, but I have seen people with $500,000 or $1 million of life insurance. And the thought process behind that, and I usually support it, and I don't say, well, that's too much insurance. I do not say that. Instead, I say, you know, this is coverage that's going to be super helpful to replicate the services that person staying at home is. Okay, enough said. We talked about life insurance. I also want you to look at your homeowners insurance. In particular, you know, if, let's say your house burnt down, God forbid, if your house burnt down, would your insurance really be able to pay for replacing your house as it is and everything inside of it? And I think for a lot of people, the answer is no. Maybe you bought your house 10 years ago and the price of real estate has gone up. I would call your insurance agent and say, help me understand the coverage I have, because I want to make sure that if something happened to my house, I could replace it. So I want you to look at that. And then there's also what's called replacement cost for the stuff that you have in your house. So let's say, you know, just to put something silly out there, let's say you have a sofa and you paid $1,000 for your sofa, but the sofa's 10 years old. The insurance company might say, well, yes, you had a sofa, but that sofa is only worth $100 now because it's so old, right? Replacement costs will give you the money to actually buy new furniture to replace that. So I want to put it on your radar screen. This is not advice on whether you should have this insurance. I just want to put it on your radar screen that something like this exists and to look into it for yourself and see if it makes sense. Okay, the next thing I want you to think about doing is maximizing your retirement savings. You know, if you're about to enter your 40s, you know how quickly time is passing now. And before you know it, you're going to be watching a video on what should my financial milestones be when I'm 50, right? So now is the time to really start piling away the money into your savings into your IRAs, into your Roth IRAs, your regular IRAs. I want you to think about having 3 buckets so that when you're in retirement, you have some money that you can access without triggering taxes, which would be like your Roth IRA, your Roth 401k, what I call a tax me never account, because you're not going to get taxed going forward on it. I'm not an accountant. It's, again, not financial advice. I want you to have another bucket, which is your tax me as I go account, which would be money like in a regular bank account, a regular taxable brokerage account. And then I want you to have some money in a tax me later account, which would be your regular 401k, your regular IRAs. And now, because you have these 3 buckets, you can be the conductor and arrange and decide how much money you take out of each of those buckets, so that you can take advantage of the lower tax brackets that the US federal government offers, the 10% bracket and the 12% bracket. So I want you to start piling away money. I want you to start saving. So how much money should you have saved by the time you're 40? Let's look at this chart from Fidelity. I think this is really well done. And in general, I agree with these numbers. Okay, so let's start at the bottom. So before you're age 30, Fidelity would say that you should have 1 times your starting salary of when you started 30. By the time you're 35, 2 times your salary. By the time you're 40, which is where we're at now, 3 times your salary. So if you're 39 years old and you're making $100,000, Fidelity would say you should have 3 times that. You should have $300,000 in your savings. Let's keep going. By the time you're 45, 4 times your salary. By the time you're 50, 6 times your salary. 55 is 7 times. By the time you're 60, 8 times. And then by the time you're 67, 10 times. So let's use that example of 100,000. Let's say you're about to turn 67 and you're making $100,000. Fidelity would say you should have $1 million. They would also say, I use a rule of 4% as a rule of thumb just for the conversation. So I would say you could take out about $40,000 a year every year and have a very high likelihood of never running out of money. Fidelity would say you could take out about 4.5%, so $45,000. So this all passes my sniff test. This is right down the center of the fairway, if you will. So I want to wrap up with some really important points here. You know, when I talk to young people, my daughters are in their 20s. When I talk to my daughters and her friends, I say, you know, your 20s are really a time to explore different careers, give yourself permission to meander, give yourself permission to change jobs, change careers, because it's super easy to do that at 20, because for the most part, they're applying for entry-level positions, and there's a lot more entry-level positions than as you get older. It gets harder to change industries because you're too senior of a level at that point. So your 20s are about meandering in your career to figure out what you like doing, and it's also about working with mentors. Choose your next job for people in their 20s based on your mentor, not based on $5,000 or $10,000 difference in salary. Okay, your 30s and 40s, which you're halfway through for this video. Your 30s and 40s, you know, is really about family. If you're interested in having a family, it's go time now from a financial standpoint. So now's the time to start making money, get promotions at work, building your nest egg. And then towards the end of your 30s and 40s, towards the end of your 40s, I want you to think about not just building your nest egg, but I want you to think about paying off the debt that might be on that nest, right? Your home. So I want you to think about trying to enter your 50s debt-free, because that's going to give you a lot of freedom. And you're going to thank you, your future self is going to thank you. Okay, so what are the 50s about? The 50s are about maybe you can ease off the gas a little bit. You can start enjoying yourself more. You've hopefully at this point gotten very good at what you're doing for a career, and you can enjoy life a little bit more. You don't have to be so competitive and going 100 miles an hour. I want you to enjoy your 50s at work, enjoy the relationships that you have. It's a lot easier to get stuff done in your career when you have a broad Rolodex, a deep Rolodex of people that are willing to return your call and help you with whatever you're trying to achieve. I also want to remind you, these are your last years with your kids at home probably. You're about to enter your empty nest years. And shockingly, by the time our kids go to college, for the most part, we'll have spent 80% of the time that we're going to spend with our kids over our lifetime. It's crazy, I know, but better to know that now. So cherish these years now. You're in your 40s. And then what do I think your 60s are for? Your 60s are for early retirement. Your 60s are for the go-go years. Your 60s are finally for you. So you start your life and it's all about you. And you know what? I think you should take full advantage of the youth of your senior years. And that's really what this video is up here. Really, I want you to enjoy the journey up until that point. So these are 7 things that I want you to stop doing as you approach your 50s and 60s so you can enjoy the journey more. I'll see you in there. Bye-bye.